The Fed Bank of Japan ECB. How interest rates work. Hey everyone, welcome back. The Fed raised rates. The Bank of Japan ends negative interest rates. The ECB signals a pivot. If you follow financial news at all, you hear phrases like these constantly. And maybe you nod along, and then immediately wonder what any of it actually means for you. Today we're answering that question directly. Central banks are the most powerful economic institutions on the planet. A decision made by a dozen people in a room in Washington, Frankfurt, or Tokyo can move stock markets, reshape mortgage rates, strengthen or collapse currencies, and ripple through the lives of billions of people who will never hear the names of the people who made it. We're going to cover what central banks actually are, how their main tool, the policy interest rate, works, and then look at the three most powerful central banks in the world: the US Federal Reserve, the Bank of Japan, and the European Central Bank. Let's get into it. A central bank is not a regular bank. You can't open an account there. You can't get a mortgage from it. It's a different kind of institution entirely, sometimes described as the Bank of Banks or the Banker's Bank. Central banks typically have three core functions. First, they are the sole issuer of a country's currency. The notes in your wallet don't come from the government, they come from the central bank. That's why US dollar bills say Federal Reserve Note on them. The Fed printed it. Second, they serve as the lender of last resort. Commercial banks, the ones you actually use, hold accounts at the central bank. When a commercial bank runs into trouble and can't meet its obligations, the central bank can step in and provide emergency liquidity. This function is what prevents bank runs from turning into systemic financial collapse. Third, they serve as the government's bank, managing the state's accounts and the issuance of government bonds. Crucially, in most modern democracies, the central bank is formally independent from the government. The finance minister can't simply call the central bank and say, "Print more money to cover the deficit." That independence is a structural safeguard against runaway inflation. The central mandate of most central banks is price stability, keeping inflation low and predictable, alongside maintaining the stability of the broader financial system. They are, in effect, the stewards of the monetary environment in which all economic activity takes place. Central banks have several tools at their disposal, but the most important, and the one you hear about most in the news, is the policy interest rate. Understanding this mechanism is the key to understanding almost everything else in macroeconomics. Interest is the cost of borrowing money. If you take out a loan at 5% annual interest, you pay 5% of the loan balance each year as the price of having access to that money. The policy rate is the interest rate at which the central bank lends to commercial banks. Here's the transmission mechanism, how a change in the policy rate ripples through the entire economy. When the central bank raises the policy rate, borrowing becomes more expensive for commercial banks. They pass that cost on. Loans to businesses cost more, mortgages cost more, credit card rates go up. Businesses facing higher borrowing costs scale back investment. Consumers facing higher mortgage and loan rates spend less. Economic activity slows. And as demand cools, price pressures ease, inflation falls. Lower the policy rate, and the reverse happens. Borrowing becomes cheaper. Businesses invest more. Consumers spend more. Economic activity heats up. If inflation is too low, or if the economy is in recession, this is the medicine. A useful analogy. Think of the economy as a large engine, and the policy rate as the throttle. Too hot, inflation running out of control, you pull back the throttle, raise rates. Too cold, recession, deflation, you push it forward, lower rates. The central bank's job is to keep the engine running at a sustainable speed. What makes this so powerful is the leverage involved. The central bank doesn't need to directly change every mortgage, every business loan, every savings account. It changes one number, the policy rate, and market forces transmit that change through the entire financial system within days or weeks. The U.S. Federal Reserve, universally known as the Fed, is the most powerful central bank in the world, and by a significant margin. The reason is the dollar's global role. As we covered in the previous episode, the dollar has been the world's reserve currency since 1944. The majority of global trade is invoiced in dollars. Oil is priced in dollars. Most international debt is denominated in dollars. When the Fed moves interest rates, it's not just adjusting the cost of borrowing in America, it's adjusting the cost of the world's most important financial commodity. When the Fed raises rates, investors around the world reallocate capital toward dollar-denominated assets, chasing higher yields. Capital flows out of emerging markets. Those countries' currencies weaken against the dollar. Their dollar-denominated debts become more expensive to service. A decision made by a committee in Washington directly affects interest rates in Indonesia, bond markets in Brazil, and currency reserves in Nigeria. The Fed's structure reflects its unusual history. There are 12 regional Federal Reserve banks across the U.S., and monetary policy is set by the Federal Open Market Committee, the FOMC, which meets 8 times a year. Each FOMC announcement is one of the most closely watched events on the global financial calendar. The Fed's 2022 to 2023 rate hiking cycle is a recent and vivid example of its power. To fight post-COVID inflation that reached 9%, the Fed raised its policy rate from near zero to over 5% in roughly 18 months, the fastest tightening cycle in 40 years. Global stock markets fell sharply. Emerging market currencies came under severe pressure. The effects were felt in every corner of the world economy. If the Fed represents conventional central banking at its most powerful, the Bank of Japan represents something more unusual. The most extreme monetary policy experiment in the history of modern central banking. To understand why, you need to understand Japan's economic predicament. After its asset bubble burst in 1990, Japan entered a prolonged period of deflation, persistently falling prices. Deflation sounds benign on the surface. Who doesn't want things to get cheaper? But deflation is deeply damaging to an economy. When consumers expect prices to fall, they delay purchases. When businesses expect prices to fall, they delay investment. Demand collapses. Wages stagnate. And because wages and demand are falling, prices fall further, a deflationary spiral. To fight this, the Bank of Japan cut interest rates to zero in the late 1990s, earlier than any other major central bank. When zero wasn't enough, they went further. In 2016, the BOJ introduced negative interest rates, meaning commercial banks were actually charged a fee for depositing excess reserves at the central bank. The intent: make it costly to hold cash, incentivize lending and investment. The BOJ also engaged in massive quantitative easing, buying government bonds and other assets at an unprecedented scale. At its peak, the Bank of Japan owned more than half of all Japanese government bonds outstanding. It became one of the largest holders of Japanese equities in the world through purchases of exchange-traded funds. Then, as global inflation surged in 2022 and 2023 and Japan finally began to see meaningful price increases, the BOJ faced a historic choice. In March 2024, it ended negative interest rates and raised its policy rate for the first time in 17 years. The global financial community watched closely. The end of Japan's long experiment with ultra-loose monetary policy had implications for currency markets, bond markets, and carry trades worldwide. The European Central Bank, the ECB, faces a challenge that neither the Fed nor the BOJ confronts. It must conduct monetary policy for 20 countries simultaneously, with a single interest rate, even though those countries have profoundly different economic situations. Think about what that means in practice. Germany might be running near full employment with inflationary pressure, arguing for higher rates. Greece or Italy might be struggling with weak growth and high unemployment, arguing for lower rates. But there is only one ECB policy rate. You can't raise rates for Germany and lower them for Italy at the same time. The ECB must find a setting that is, in a sense, wrong for everyone and least wrong for the aggregate. This structural tension erupted into crisis during the European sovereign debt crisis of 2010 to 2012. Countries like Greece, Spain, and Portugal faced spiraling borrowing costs and economic collapse. Unlike countries with their own currencies, they couldn't devalue their way out, they were locked into the euro. The ECB had to act, but its mandate was price stability, not bailing out governments. What resolved the crisis was not a policy rate change, it was a sentence. ECB President Mario Draghi, in July 2012, said the ECB would do whatever it takes to preserve the euro, adding, "And believe me, it will be enough." Bond spreads in Southern Europe collapsed almost immediately. Markets believed him. This remains one of the most remarkable examples of central bank communication in history, a few words that did the work of hundreds of billions of euros in intervention. This brings us to a broader point. Central banks don't just act through policy tools. They communicate. Forward guidance, signals about the future direction of policy, can move markets as powerfully as actual rate changes. When the Fed chair suggests rates will stay higher for longer, that statement immediately changes the behavior of investors, lenders, and borrowers around the world. Let's bring this together. Central banks are the institutions that govern the monetary environment in which all economic activity takes place. Their primary tool, the policy interest rate, works by changing the cost of borrowing throughout the financial system, which then affects spending, investment, inflation, and growth. The Fed is the most globally powerful, because the dollar is the world's currency. The Bank of Japan ran the most extreme monetary experiment in modern history, in its decades-long battle with deflation. The ECB faces the structurally impossible task of running one monetary policy for 20 economically diverse nations, and manages, mostly, to hold the euro together through a combination of policy and communication. None of this is abstract. The interest rate on your mortgage, the return on your savings account, the value of your investment portfolio, the prices you pay at the grocery store. All of these are downstream of decisions made by central bank committees that meet several times a year in quiet rooms in Washington, Tokyo, and Frankfurt. Understanding central banks means understanding the machinery behind the economic conditions of your daily life. Next episode in this financial series. What is the stock market, and how does it actually work? Thanks for watching. A subscribe and a like really helps the channel. See you next time. Don't miss the next episode. Subscribe to the channel and hit the bell.